VIP John AG here. In exactly 3 hours, Asian markets open, and silver is sitting at a level that could determine whether we see a breakout or a breakdown over the next 48 hours. The spot price right now is hovering around $32.40, and that number matters more than you might think. Shanghai traders are about to wake up, and they've been paying premiums that Wall Street analysts can't explain away. We're talking about a divergence between East and West that's widening by the day, and tonight's session could be the catalyst that forces one side to blink. I've been tracking this setup for the past 72 hours, and what I'm seeing in the data tells me something significant is brewing. If you hold physical silver, you need to understand what happens next. This is not speculation. This is pattern recognition based on documented evidence. Let me walk you through what's happening right now in real time. Silver closed the New York session today at $32.42 on the COMEX. Gold is trading at $3,231 per ounce, holding steady after a week of consolidation. But here's where it gets interesting. The Shanghai Gold Exchange opened their last session with silver trading at a premium of roughly 3 to 4% over the COMEX price. That might not sound like much until you realize what it means. Chinese buyers are willing to pay significantly more for physical metal than the paper price suggests it's worth. This is not a one-day anomaly. This premium has persisted for months, and it's telling us something the mainstream financial media refuses to acknowledge. The COMEX registered silver inventory currently sits at around 270 million ounces. Sounds like a lot, right? But let me put that in perspective. Global industrial demand for silver in 2024 exceeded 650 million ounces. Solar panel production alone consumed over 200 million ounces. That means the entire COMEX registered inventory could be wiped out by just 5 months of solar demand. And here's the thing. That inventory number is paper claims, not necessarily physical metal ready for delivery. The eligible category, which is metal that could theoretically be converted to registered, adds another 100 million or so. But eligible means the owner hasn't committed it for delivery. It's sitting there, and there's no guarantee it moves. Now let me connect this to what's happening tonight. Asian markets have been the primary driver of physical demand for precious metals over the past 18 months. China imported record amounts of gold throughout 2024, and their appetite for silver has followed the same trajectory. When Shanghai opens in 3 hours, traders there will be reacting to everything that happened during the New York session. They'll see that silver held above $32 despite pressure from a strengthening dollar index, which is currently trading around 104.2. They'll see that gold maintained its position above 3,200. And they'll make their moves accordingly. The level I want you watching is $32, not $32.50, not $31.80, $32 flat. This is the psychological and technical support that has held through multiple tests over the past 2 weeks. Every time silver has dipped below this level intraday, buyers have stepped in within hours. The question is whether that buying comes from paper traders covering shorts or from physical demand flowing through Shanghai. And based on the premium data, I'm betting it's the latter. Let me give you some context on what the Federal Reserve is doing and why it matters for tonight's session. The Fed held rates steady at their last meeting, keeping the federal funds rate between 5.25% and 5.5%. Markets are now pricing in roughly 2 rate cuts for 2025, down from the 4 or 5 cuts that were expected at the beginning of the year. This uncertainty is creating volatility in the dollar, which directly impacts precious metals pricing. A stronger dollar typically pressures gold and silver because it makes them more expensive for foreign buyers. But here's what's fascinating. Despite the dollar holding relatively strong, silver has maintained its position. That tells me physical demand is absorbing the paper-selling pressure. The geopolitical backdrop is adding fuel to this fire. Tensions between the United States and China continue to escalate over trade, technology, and Taiwan. Russia's actions in Ukraine show no signs of de-escalation. The Middle East remains a powder keg with ongoing conflicts affecting energy markets and safe haven flows. Central banks around the world are continuing to accumulate gold at a pace not seen since the 1960s. China added another 18 tons to their official reserves last month. Poland, Singapore, and Turkey have all been consistent buyers. These nations aren't accumulating gold because they think the dollar is strong. They're hedging against a monetary system they no longer fully trust. The BRICS nations held discussions last month about expanding their alternative payment systems, and while a gold-backed currency remains more speculation than reality, the direction of travel is clear. The East is slowly but systematically reducing its dependence on the dollar-denominated financial system. And in that transition, gold and silver become strategic assets, not just investment vehicles. Looking at the numbers, about 75% of you watching aren't subscribed. If this unfiltered analysis is cutting through the noise and giving you clarity, hit subscribe. That's how we grow a community built on truth, not hype. Drop VIP John AG in the comments so I know you're part of the crew. If it's not for you, no hard feelings. I don't chase empty metrics. I don't sell signals. I don't offer mentorships or courses. This channel exists to share research and perspective. Nothing more. Here's where it gets truly insane. While the paper price of silver has been chopping sideways between $31 and $34 for weeks, the physical market is telling a completely different story. I spoke with 3 different dealers this week, 2 on the East Coast, 1 in Texas. All 3 reported the same thing. Inventory of popular products is thin, and premiums remain elevated despite the sideways spot price. American Silver Eagles are still commanding premiums of $6 to $8 over spot. Generic rounds and bars are tighter than they should be for a market that mainstream analysts call well-supplied. And here's the smoking gun. The United States Mint reported that Silver Eagle sales for the first quarter of 2025 are tracking ahead of last year's pace. Let me say that again. Despite a spot price that's gone essentially nowhere for months, retail demand for physical silver remains robust. This is not the behavior you'd expect if silver were truly in a surplus, as some banking analysts claim. This is the behavior of a market where physical demand is being met with paper supply, and the disconnect is widening. The Shanghai Premium is the clearest evidence of this divergence. When Chinese buyers consistently pay 3, 4, sometimes 5% more than the COMEX price, they're telling you the COMEX price is wrong. They're telling you the paper market is undervaluing the physical metal. And when Asian markets open tonight, those buyers will either validate the current price level or push for higher ground. The premium acts as a magnet, pulling price toward true physical value. It doesn't happen overnight, but over time, physical reality always wins. Now let me be crystal clear about the difference between the physical market and the paper market, because this is fundamental to understanding why tonight matters. The COMEX is a futures exchange. Most contracts are settled in cash, not metal. Traders are betting on price direction, not seeking physical delivery. This creates a market where the price can be influenced by large positions, leverage, and timing. When a major bank wants to cap the price, they can sell thousands of contracts in minutes, overwhelming any buying pressure. We've seen this pattern repeatedly, especially around options expiration and key technical levels. The physical market operates differently. When a solar panel manufacturer needs silver, they need actual metal. When a central bank accumulates gold, they take delivery. When a retail investor buys coins or bars, they hold them in their hands. This demand is inelastic. It doesn't disappear because the paper price dropped 2%. If anything, lower prices stimulate more physical buying, which is exactly what we're seeing. The Shanghai Gold Exchange operates closer to a physical market than the COMEX. Delivery rates are higher. The premium over Western prices reflects real tightness. When you see that premium persist and even expand, you're seeing evidence that the paper price is being artificially suppressed. The question is how long this divergence can continue before something breaks. The mining supply situation adds another layer to this analysis. Global silver mine production has been essentially flat for years, hovering around 820 to 840 million ounces annually. Meanwhile, demand has grown. Industrial applications now consume over half of annual production. Solar alone is on track to use 250 million ounces this year. Electric vehicles, fifth-generation wireless infrastructure, military applications, and artificial intelligence data centers are all increasing their silver consumption. The math doesn't work. Demand is growing. Supply is stagnant. Inventory is being drawn down. And the price is sideways. Let me address the bearish case head-on because balance matters. There are legitimate reasons to be cautious right now. First, the dollar remains relatively strong. If the Fed delays rate cuts further, or if inflation proves stickier than expected, the dollar could strengthen more, putting pressure on metals. Second, COMEX margins could be raised. We've seen this playbook before. When silver starts to run, the exchange raises margin requirements, forcing leveraged longs to liquidate. A margin hike could trigger a quick 10 to 15% pullback, regardless of physical fundamentals. Third, a broader market sell-off could drag silver down with it. During the 2020 crash, silver fell to $12 before anyone could blink. In a liquidity crisis, paper assets get sold to meet margin calls, and silver is not immune. Fourth, China's economy is facing headwinds. Property sector troubles, slower growth, and deflation concerns could theoretically reduce industrial demand. If Chinese solar installations slow, or if their manufacturing sector contracts, silver demand could soften. These are real risks. Anyone telling you silver is a guaranteed winner is either lying or selling something. I'm neither. You need to understand both sides of this trade. But here's the bullish case, and this is why I remain long-term confident despite short-term uncertainty. The structural deficit is not going away. For 4 consecutive years, global silver demand has exceeded supply. The deficit in 2024 was estimated at over 200 million ounces. That's not a small gap. That's a chasm that can only be filled by drawing down existing inventory or by price rising high enough to stimulate more recycling and mining investment. JP Morgan's position in silver has been a subject of intense speculation for years. While they've reduced their massive short position from the levels seen in the early 2000s, they remain a major player in this market. More importantly, large commercial banks have been reducing their net short exposure in recent months, according to the Commitment of Traders reports. When the big players stop fighting the trend, they often flip and ride it. That transition may be happening now. Central bank accumulation of gold, while not directly a silver story, creates a rising tide that lifts all precious metals. When nations signal distrust of the current monetary system by hoarding gold, investors pay attention. Silver typically lags gold in the early stages of a precious metals bull market, but outperforms in the later stages. The gold-to-silver ratio currently sits around 100 to 1. Historically, that ratio has averaged closer to 60 to 1 over the past 50 years. A reversion to the mean would imply significant upside for silver relative to gold. Industrial demand is not speculative. It's measurable and growing. The International Energy Agency projects solar installations to triple by 2030. Each gigawatt of solar capacity requires approximately 50,000 ounces of silver. Electric vehicle production continues to expand globally, with each EV using roughly 1 to 2 ounces of silver in electrical connections and contacts. The military applications for silver in precision weaponry, satellite systems, and communications equipment are classified but substantial. This is not hope. This is documented demand trajectory. 3 key takeaways and we're out. 1. The $32 level is critical support for silver going into tonight's Asian session. If Shanghai buyers defend this level with the same enthusiasm they've shown via their persistent premium, we could see a bounce that carries into the London and New York sessions tomorrow. Watch the premium. If it expands, buyers are stepping in. 2. The divergence between paper and physical markets is widening, not narrowing. COMEX inventory is being drawn. Dealer premiums remain elevated. Shanghai continues to pay more than New York. These are not bearish signals dressed in bullish clothing. These are genuine indicators of physical tightness that the paper market will eventually be forced to recognize. 3. Risk management matters. Nobody can time the perfect entry or predict the exact catalyst. Position sizing, cost averaging, and understanding your own risk tolerance are more important than any single price level. This is a long game. Short-term volatility is noise. Long-term fundamentals are signal. The unresolved tension is this: how long can the paper market diverge from physical reality before something breaks? We've seen these disconnects before. They don't last forever. When they resolve violently and quickly. Is tonight the night Shanghai triggers that resolution? Probably not. But every session that the premium persists, every day that inventory declines, every quarter that demand exceeds supply, we move closer to that inflection point. And when it comes, Those who positioned beforehand won't need to chase. They'll already be holding. As I said in the previous video, the setup is there. The fundamentals haven't changed. What changes is timing, and timing is impossible to predict with precision. So you prepare. You accumulate on weakness. You hold with conviction. And you don't let paper volatility shake you out of a position built on physical reality. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Nothing I share here is financial advice. It's analysis. It's perspective. It's pattern recognition based on data that anyone can verify. What you do with it is entirely on you. For those staying up to watch the Asian Open, pay attention to the first 2 hours. That's when the heaviest volume typically flows through Shanghai. If silver holds 32 and the premium ticks higher, bulls have another brick in the foundation. If it breaks below with conviction and Shanghai doesn't defend it, we may be looking at a retest of $30 before finding footing. Either way, the data will tell us what's happening. Our job is to listen. Thanks to the OGs who've been with this channel since the early days. Thanks to the new members of Team VIP who are just discovering this community. We grow by sharing truth, not by chasing algorithms. If this video helped you see the market more clearly, pass it along to someone who needs it. That's how we build something real. Invest with logic, not hype. VIP out.